Holy crap, this is absolutely insane. In this video, I'm going to show you how to get a 12% cash-on-cash return in real estate in 2024. Now, this is completely nutty that this is even possible, and these deals are not the easiest to get, but they're possible, and I'm blown away as to them actually being possible. So first, why? Why are these deals possible? And then two, give an example and where do you get them? Okay, so first, why are there deals in real estate right now? Multifamily rents are starting to fall. If you're buying multifamily right now and you are not underwriting that multifamily rents are falling, you're screwing yourself. You need to go in realizing that multifamily rents are falling. They've already fallen anywhere between $200 to $600 in most cities throughout the entire country. Now, that does not mean they are lower than 2019. 2019 rents could be here. Now they might be 30% higher. So a $2,000 rent might be somewhere around $2,600. Maybe it's come down $200 to $2,400. So it's still 20% fatter than what you had in 2019. That sucks as a tenant. But for multifamily, you got to be careful as an investor paying a $2,600 valuation, right? I mean, simple. How do you value multifamily real estate? It's very simple. Take $2,600. Watch the difference. $2,600. Let's say it's a 10-unit apartment building times 12. That gives you gross scheduled rent, GSI, of $312,000. Very, very simple, okay? Now I want you to multiply that by a gross rent multiplier. You don't even need to ask what the expenses are. In fact, your cap rate should align with your gross rent multiplier. If you use the same expense ratio, it's the same freaking thing, okay? Let's multiply it by 15 times gross. Hit enter. How much is that building worth? $4.6 million. Very simple. 2,600 times 10 units times 12 times the 15 times gross. How do you figure out what the gross is? You look at what the other buildings are selling for in the neighborhood. But what happens if you now have to take that $200 off the rents, and so every time your tenants turn, you lose $200, so you're down at $2,400. Well, that $4.68 million building loses $300,000. Boom, just like that, down to $432. Yeah, so you really got to be careful because every dollar makes a big impact on price that you're not getting in rent, and it's amplified by how many units you have. So, what does this mean? Well, this means right now, as there are a lot of new construction multifamily developments that are hitting the market, especially in the Sun Belt area, and you got to be careful of this, okay? The Sun Belt area is saturated with these developments right now, but in my opinion, they're the ones that are going to see the largest pain in rents coming down, which creates an opportunity if you underwrite it correctly. So, Sun Belt areas, easy to build areas, Texas, Florida, Tennessee, even quite frankly, Arizona. A lot of folks are still looking at those markets saying, wow, the rents are so high. They're not even looking that there are probably 2 months worth of concessions and rents to prop up the rents to get some of these rents. You gotta be very careful about concessions as well. A lot of ways to get scammed in multifamily. I'm trying to give you the warnings here, okay? I mean, think about it. If somebody's like, oh, the unit's renting for $3,000, but they had 2 months free, okay? $3,000 is what you think the rent is. Well, times 12, you should be collecting $36,000 a year, right? But they had 2 months free, so you're really only collecting $30,000, which means you're not getting $3,000 a month. You're getting $2,500 a month. That's a huge difference. So that's a great way to get screwed on multifamily again, concessions. Anyway, they mask rent drops, right? Okay, so what do we have? How do you get good deals in multifamily? Well, first of all, you need to realize that easy to build markets, like I said, Texas, Tennessee, Florida, whatever, you're going to get a lot of supply coming on of multifamily apartment units, less so single family. Single family is a whole nother story. Quick tangent on single family. There is so little inventory right now. The worst of the last year. It's gotten worse. Like October was fantastic. Great time to buy. We bought a bunch. November, still a good time to buy. December became less of a good time to buy. January so far, terrible for single family. Because you had all the listings expire at the end of December that got stale and their listings, expired. Now people are waiting for the spring or the first rate cut to actually list their homes because they think people hear, oh, rates down, prices up. Inventory is going to get saturated on SFDs, so be careful about that one. But what we are seeing with certainty is multifamily, an explosion of multifamily apartment buildings That leads to a greater supply of apartments, which leads to prices coming down. Makes sense. You also have less of that migration from the West that you used to have. Remember during COVID, the idea was, oh, everybody's leaving California to go to Florida, Tennessee, freedom states, whatever. You have less of that migration now. You have more of a reversal of COVID trends. People getting called back into the office, back to San Diego, back to Silicon Valley, whatever it might be, back into the cities. So you have building that was speculating on, yay, rents skyrocketing. Now you've got that supply dumping on the market. At the same time as interest rates are too high for sellers to be able to refinance their loans, what happens? Boom, they default. But they're defaulting on assumable loans, folks. Now here is the opportunity. You ready for this? This is the kind of stuff we do on a daily basis. People like, Kevin's over here in a gnome sweater in February talking about the real estate market and opportunities in the real estate market. And you know what I say to that? Correct. So now I'm going to show you a real deal that we are in escrow on. I've changed the numbers slightly. The cash on cash return is the same, but I've doinked with some of the numbers, mostly because I don't really want to give away where the deal is or what the deal is yet. I got to keep some competitive advantage. Okay, you're getting enough already. We're going to go through these numbers, and I'm going to show you exactly how this works. And then you'll see what you want to start looking for, okay? Ready? Here we go. Right here. Let's say somebody has a property with a loan in default worth $9.45 million, okay? That loan is a Fannie Mae assumable interest-only loan due in 2028. I think ours is 2028 or 7, something like that. And they're in default because they've over-leveraged on other projects, because they're building in certain areas, cost of a building went up, potential resale value went down, they're in the poopers, okay? And they can't refinance because rates are crazy. But that loan's financeable at, let's call it 3.5%. Loans in default. We could buy the building for, let's say, $13,190. It's got a rents per door of about $18.90. So what are we going to do? We're going to take $18.90 times however many units we have, 1820 rather, 1820 times 50 units or 55 units times 12. That gives us about, what is that, $1.2 million of gross scheduled income. Yep, there you go, GSI, $1.2 million. Now we're going to take a generic expense ratio, multiply by 65%. What do we get? We get $780,000 of net operating income. Now be careful, you can't use 65% in a place like Texas because the property taxes are double. You're going to get reamed, so you probably got to be closer to like 0.5. So be careful where you're using your expense ratios. Okay, great. Now we're going to take off our debt service. This is very easy to multiply. We're just going to take the loan in default, multiply it by 3.5%. Okay, what are we left with? Cash, net, $450,000. Okay, divide that in to your cash outlay. So how much money did we spend on this building? Only 3.7. Well, wait a minute. If we divide those two, it's 12% cash on cash return. Boom. Why? Because when your cap rate is greater than what you can get on debt or what you pay on debt, you make more money. Your cash on cash return goes up. So you can actually buy a lower cap, high quality building and actually get really good rates of return. You know, obviously until the loan comes due, and then you got to refinance, you know, what happens if that resets higher, whatever. You got 4 years to figure it out. Yes, that is a risk. You are being compensated to some extent for that now, but quite frankly, I think the seller is doing most of the compensating. Again, this is why they say money in real estate is made on the buy. So anyway, let's look at the cash on cash return on this ordinarily, right? Or the cap rate on this. So the cap rate on this would be 980 NOI here, and then we're going to divide that into the price. There we go. Yeah, so your cap rate on this deal would actually be closer. This might be rounded, so it's probably like 5.5%. Oh, 5.9%. So look at that. Your cap rate on this deal is 5.9%, but your cash on cash return is 12.03. Now, one of the reasons for that is because they have such a large loan that's assumable on a building value that's actually low. So you actually have a lot of leverage here. I mean, consider this for a moment. You take out a loan of 9,450 divided by 13,190. you know, you're leveraging this up to 71%. So in our case, I'm going to do my numbers really quick. Yeah, we're at 72%. Kind of wild. So that's what I'm saying. These numbers, they're not exactly our deal. Our deal numbers are larger than this, but they roughly align with this. And what we're doing is we're buying this with househack. So we're able to use the money we raised to negotiate great deals like this. Then we stabilize the properties if they're not already stabilized. And then we can, you know, get to phase 2, which is our mini funds phase. Now, we're actually going to be raising money for househack probably next week again. If you're an accredited investor, buckle up. Probably Thursday or Friday, we'll launch the accredited round again. This is the last time we're going to raise money before we do mini funds, which if mini funds go the way we expect, we think we'll never have to fundraise again for househack because the cash flow should be fantastic. Should be. No guarantees. I can't make those guarantees. Could be terrible. So we're very excited for that, but this is what we're focused on. So how do you practically, as a viewer, look for this? Well, first of all, you have to have cash. And most importantly, beyond cash, you have to have the ability to underwrite deals. I teach this in my 0 to Millionaire Real Estate Investing course, but I mean, frankly, what you really need to do is when you're looking at rents right now, you just need to discount them. You need to discount the rents to get quality tenants so you can actually stabilize a building. Because if you can't stabilize a building, you're screwed. Vacancy sucks. A lot of people have a lot of vacancy in buildings because they don't know how to manage real estate. I deal with this all the time. In fact, most of the time when we're buying buildings, we're buying buildings that have been poorly managed. And because they're mismanaged, we go fix the problem and we get paid for doing that. But property management is something that I've done for what? I mean, how old am I? I don't know, 32, so 14 years, you know, since I was 18. So if you can master property management, you could solve these problems. If you then have cash to pick up assumable loans, you could write low offers on deals and hopefully assume their financing. Now, there's no guarantee you'll be able to assume the financing. That's the other risk factor you run into. You might go call up Fannie Mae and they go, nah, just pay us off, cash. Okay, well, in that case, I guess you're stuck with a 5.92 cap. It's not a bad deal either, but, you know, a lot of people are going to look and go, oh, but treasuries, you know, you got 5% on money markets right now and 1-year treasuries. Fine, it's true. But if you get a good buy in a deal, hopefully you're going to be looking at leverage depreciation plus that cash flow, right? Plus the tax benefits. So, you know, obviously real estate's a different instrument than like a treasury bond. But anyway, this is fascinating. And I think there are a lot of opportunities out there. We think there are way fewer opportunities in single family this moment in time. I think that's going to flip-flop again, maybe this summer as we get excess inventory of houses and rates that don't actually come down as quickly as people think. Even if we start cutting rates, what's 25 bips do? Not that much for a homeowner. So that's why right now we see huge opportunities in multifamily. You have to be careful of where you're buying them though, because there's a lot of development. We're trying to look for lower development areas where we're a little bit more insulated and protected from a massive surge of new inventory coming on. And ideally, there are a lot of jobs. So lots of jobs, less development, great place to buy. Especially if you could find somebody in default with an assumable loan that even though that loan is in default, you can still take it over and bring it current with the seller back paying it. Those are a lot of conditions. I'm just saying, that's what we're doing all day long. And we have a team at househack who's doing that. But I wanted to share this mostly because there's so many deals out there right now. I'm looking at deals. I'm like, wow, we could probably deploy another $200 million, but we don't have another $200 million right now because there's so many deals. And so, but we enjoy this. So this is what we're doing. We're growing our real estate startup. We're growing our property management division. We're creating a scalable enterprise. And it's a lot of hard work. It means I'm traveling more and posting on YouTube less, but that's okay. It's a balance, you know? Some weeks I post very little, sometimes I can post more. So it's very interesting, but very excited for the team. Shout out to the entire team while we're growing. And hey, if you come across an opportunity, send it to me, kevin@househack.com. Really appreciate you. Thanks so much. Stay tuned for the next fundraise coming and the warrant call probably end of next week if we can get it situated, which we should be able to. Thanks so much. We'll talk soon, and I'll keep you updated. Bye.
why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than househack, nor am I presently acting as a market maker.